The way the monetary system works is there is a monetary base. That's called base money. So the base money is literally the currency and coins we walk around with in our pockets. And then it's the reserves, the savings, for lack of a better word, that the banks put with the Federal Reserve. If you add those two together, you get approximately $4 or $5 trillion. All the other money that exists in the world is loaned into existence using that 4 or 5 trillion as the collateral. So what that means is if you have if M2, which is another measure of money, is 20 trillion, then that means there's 4 or 5 trillion of base money, and then it's levered up 4 times, right? So there's a leverage ratio there of like 400%. And that works. That's the way the whole world works. It's not just England does the same, European Union does the same, China does that. That's just the way it's a based monetary system. But let's think about this. So let's pretend in this room, this is the whole world. There's no place else. And we've got 5 trillion of base money, and then we make 15 trillion in loans, right? We fast forward a year. We need new money to pay the interest because there's interest on loans, right? So where does that money come from? Well, there's only 2 places it can come from. Either the money has to be circulating fast enough that $1 can pay more than $1 of interest, right? Or somebody has to come in and put new money into the system, or increase the amount of collateral so that the system stays in balance. And that's where the Fed comes in. So when you get into a recession, so when money is being created, new loans are being created, new money is being created. So when somebody takes out a mortgage, they have a new debt, but there's also, let's say they buy $1 million house. The bank gives them $1 million, but there's also a new $1 million that's in the economy that wasn't there yesterday, right? And as long as people are buying houses and buying refrigerators and flying on airplanes to go on vacation and putting gas in their car, those dollars are circulating. That's the velocity of money. And as long as that's happening at a speed high enough to serve all the interest payments, everything's fine. But this is the problem with the reverse gear, is when money stops circulating, there is no reverse gear, because the reverse gear causes those loans to start defaulting. And then just like in 2008, when you had one default, it led to another default, it led to another default, and then you get a contraction or a crash. And so that's what I mean by the system doesn't have a reverse gear. In other words, for our economy to continue to function, it has to grow. And that is a function of the design of the system. Now, some people will say that's a design flaw. Other people will say they purposefully did it like that because there's a group at the top that can skim off the top, and they can, they can benefit from all of the pain of others. And when when it's time for the bailouts, those who took all the risk and lost all the money, they get bailed out at the expense of everybody else.
Yeah, I mean, what a great system that is.